everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. A recurring theme I've been really emphasizing during the two big rallies in the Treasury market just within the last year has been at some point that visible decline in yields needs to be validated. And investors saw this phenomenon play out earlier this year when Treasury yields reversed course and retraced a good portion of the decline in rates that we saw in the fourth quarter. So here we are now almost a year later, and investors have been witnessing another episode of a Treasury rally that hasn't received the necessary validation. Actually, it's been quite remarkable to see the complete 180 the money and bond markets have experienced just with only the last few weeks. I mean, think about where economic and Fed rate cut expectations were right after the September FOMC meeting to where they are currently. Right around that mid-September timeframe, the narrative was the labor market was cooling more than expected, disinflation was firmly intact, and the Fed's 50 basis point rate cut was only the beginning. So let's provide some perspective. Implied probabilities for Fed funds futures were pricing in a total of 8 rate cuts. Now that's going to assume 25 basis point intervals, worth a cumulative total of an eye-opening 200 basis points by Q4 of next year. And for those keeping track, that would have brought the Fed funds target range down to around 2.9%. Needless to say, Treasury yields followed suit, with the 2-year plunging 144 basis points from its late May high watermark down to just barely above 3.5% as recently as September 24th. And the 10-year got into the action as well, and the yield here fell around 100 basis points to about 3.6% on September 17th. So that was then. What about now? Well, the recently released jobs report revealed that while labor market activity may be cooling, it was not nearly as cool as to what the markets were thinking a few weeks earlier. And throw in the addition of the September CPI data that the improving inflation picture may have hit a possible roadblock. This landscape is materially different from when Powell and company met less than a month ago. So against this backdrop, Fed rate cut expectations have been dialed back to where only about 5 or 6 decreases are expected by Q4 of 2025. In fact, a modest probability has now been given for no rate cut at the upcoming November FOMC meeting, where pre-jobs report, the odds were going back and forth between a 25 or a 50 basis point cut. So Treasury yields, again, have retraced anywhere from just under 30% of that previously mentioned decline for the 2-year note to a more substantial move of almost 50% for the 10-year. And once again, for those keeping track, these are upward moves of about 45 and 50 basis points respectively, bringing absolute levels back to the 4% threshold, if not higher in the case of the 10-year note. Now, due to the unfortunate events from Hurricanes Helene and Milton, the rest of October really is going to be the last few weeks of relatively clean sets of data for a while. In fact, last week's jobless claims did reveal the first signs of these adverse effects already. So as a result, the data released up to now may take on heightened importance for the bond market and the Fed, because it could be the last time for a few months we'll get a truer sense of what underlying economic, labor market, and inflation trends are. So I'm going to end it there. I hope everybody has a great rest of the week and be well.